Good morning, friends. On behalf of Banking Quest, I Tilagulati extend you warm welcome. Friends, in this training program on risk management in banks and NBFCs, today we are going to have the eighth session. We had already covered understanding financial risk by Professor Rajesh Mahajan, credit risk in corporate finance, including working capital analysis by Mr. S.S.N. Murthy, credit risk in project finance by Professor Rajesh Mahajan, calculating credit risk weighted assets under standardized approach by Mr. S.S.N. Murthy, liquidity risk measurement by applying flow approach and stock approach by Mrs. Shashikala Ramachandra, analysis of interest rate risk by Mr. S.S.N. Murthy, operational risk framework by Mrs. Hemlata Mohan. Today we are going to deliberate upon introduction to financial market, and I'm happy to announce that we have with us Mr. Hargovind Sachdev. Mr. Hargovind Sachdev, former General Manager, State Bank of India, has over 39 years of banking experience, having occupied senior positions in UCO Bank, United Bank of India, State Bank of Patiala, State Bank of Travancore, and State Bank of India, where he headed the Central European Credit Desk at Frankfurt, Germany, covering 15 countries of Central Europe. Mr. Sachdev has undergone international banking training from Asian Institute of Management, Manila, Philippines, and a multi-currency lending technique training at the Euro Money Institute, London. Mr. Hargovind Sachdev has specialization in credit, foreign exchange, vigilance, monitoring and appraisal of corporate loans, MSME credit, gold loan, agriculture loan, and NRI business management in assets and liabilities. Mr. Hargovind Sachdev is an independent director and a consultant to various big entities in the corporate sector. I welcome you, sir, over this platform. I request Mr. Hargovind Sachdev to kindly start his deliberation on financial market.
Gulati Saab, thank you very much for a very liberal introduction. आना तेरा मुबारक, तशरीफ लाने वाले, खुशियां मना रहे हैं तुम सबको पढ़ाने वाले. Worthy colleagues, it's a great honor welcoming each one of you on the auspicious platform of Banking Quest, so nicely nurtured by the leadership of Shri Gulati, wherein we meet periodically to share our thoughts. Today's topic is a fantastic topic because it is spun around each one of you. As banker or former banker, you are the key players, creators, and if I permit to say, destroyers of financial market if you do not do it nicely. So it will be of great interest. I only request you to kindly look around and find that how important role a banker plays in what is called as world's largest market called financial market. Friends, today's agenda would be a bird's eye view of Indian financial markets comprising of money market, capital market, commodity market, spot market, Forex market and derivative markets. On way, we will be seeing the other smaller markets related to each one of these bigger markets. Then we will come to the crux of today's deliberation, that is derivatives. And we'll go through the OTC, that is the over-the-counter derivatives, and also the derivatives which are traded in exchanges. And of course, we'll have bird's eye view of forwards, futures, swaps, and options. I begin with the prayers of the God of knowledge and the God who is the creator of this world, Lord Shiva. Friends, there was this friendly competition between the two sons of Lord Shiva and Parvati to establish who is the stronger of the two and who should be worshipped first. Lord Shiva requested his sons to go around the world 3 times and find out who comes back first and faster and safest. and whosoever would be the winner would be worshipped first. Kartikeya started on his peacock, the fantastic peacock which used to fly also, and was already halfway through when he found that Lord Ganesha had not even started his journey. And at that stage, Lord Ganesha just stood up and took 3 rounds of the constum, the sanctorum where Lord Shiva and Lourdes Parvati were presiding, went around 3 times and sat in their feet and said, Lord Shiva and Parvati, you are my word, because you have created me, you have nurtured me, you have made me what I am today. And then when Kartikeya came and said that I have done 3 rounds faster, he was told that you are second, because Lord Ganesha has realized what actually is the true word creator. So feel pride that as banker, you are the creators of the finance market in the world. If you do not issue a draft at the counter, if you do not lend for 1 year, if you do not lend for long term, if you do not take a person to stock market, creating ASBA accounts, if you do not sell mutual funds, then what you will not be creating is what is called as financial market. And if you do all this, which most of us do, then we are the creators of finance market. So it is in our activities that lies the future of this great market. Well, let us understand what exactly are financial markets. Financial markets, are places that provide an avenue for sale and purchase of assets, especially the financial assets such as bonds, stocks, foreign exchange, and derivatives. As you know, there is a flower market, there is a vegetable market, there is a wholesale market, there is a retail market, there is a mall where you can get so many things of consumer durable or day-to-day needs. When you go to a market where you can get these financial products, then you are supposed to enter a financial market. Now, this financial market may be a physical market or maybe a non-physical market available on your computers. So it is not necessary that it should look like a mall. A financial market is a market in which people trade financial securities. Now, this is another facility here that normally to a normal mall you go, you are normally buying things. If you go and go try to return a thing, the shopkeeper will give 5 reasons of not taking it back. He'll say, come between 12 and 3 o'clock on Monday, Wednesday, and Thursday. Then only we'll take back. But these financial markets, have great liquidity. These are markets where you can trade your financial security. You can buy and sell simultaneously so many times in the day. And being such a huge market with participants, spanning the entire globe, having access, so the transaction costs are very low. Securities including stocks, bonds, raw materials and precious materials, metals, gold, mint, etc., they are also part of this financial market, sold as commodities. And as all of us know, a bank, when you enter there and take a wad of currency notes, it takes it as a deposit and you get something what is called as interest. Now, you all earn interest, and when this money is lent to a company or a housing loan aspirant or a car loan aspirant or a project creator, then this money goes there. So what you do in the process is create a financial market where there are so many winners. The depositor is a winner by depositing, the borrower is a winner by taking, and everybody gives a cost for that, which is pretty reasonable. What are the functions of a financial market? Financial markets like banks open up public savings to individuals and companies that need a home loan, student loan, or a business loan. As you all know, banks are only aggregators. They convert short-term funds or the small amount of funds into big corpus, and thereby the nation, grows because large number of factories with huge capex, they come out of this public saving. So financial market is a very important fulcrum of growth of any nation. Unlike goods and services whose price is determined by the law of supply and demand, prices of securities are determined by financial markets. See, so many brains, they will be chasing a particular company's stock when it comes through IPO. So they all do a lot of diligences. So unlike goods and services, which are purely, demand and supply based, the prices of securities are determined by financial markets through various types of due diligences. It's not only demand or supply. Of course, demand is there that creates premium. But only if a stock is good, the performance of the promoter is good, it will command a true premium in the long run. Buyers and sellers can decide to trade their securities anytime using financial markets, which provide liquidity to sell securities. See, the best thing, why stock market in India is on fire today? Because all said and done, with all our infirmities of the system, the stock market is performing because the settlements are T+1. Today you want to sell stock, you can sell and then you can buy again. And it's such a transparency and such speed that, people are seeing their money grow. So financial markets are, very sophisticated markets where people have tremendous confidence that their money, once they decide, will, really grow. Or they are also, ready to accept the losses because it is their, considered decision which makes them invest in a particular security. The financial markets are facilitators of these aspirations and dreams of the common investor. Financial markets transactions can be done sitting at home. It's very comfortable sitting at your computer or within your mobile while talking to somebody. You can enter a trade, you can dispose of a stock, you can sell a share, you can buy a bond. So financial markets are very easily accessible to you everywhere. Some of the activities, which I will again emphasize is that it's a great creator of funds. You can mobilize huge amount of fund. Lot of ambience is created by finance markets and a lot of due diligence. SEBI is our watchdog for investments. They do huge, we have heard that now Paytm is trying to come to the market, and then it's almost 1 year that this Paytm is going to SEBI, and then they're asking for so many things. He has to change his board, he has to change his directors and equity and all those things. So there is a inbuilt mechanism of safety for investors. That's why they are great source of fund mobilization. Fund mobilized through banks, mutual funds, NBFCs, and shares, etc., which are part of this finance market, can be used for project funding, individual sinking to liquidate FDRs, equity, bonds. Holdings can easily raise liquidity in financial markets. The best thing about this is that this is very seamless process in a financial market. You can just go open FDR, next day you want it. If you want part of it, you take a part of it as a loan, which you can pay, or if you want full amount with interest, you can get that also. So they are very liquid and they provide opportunities to buy and sell at any time you need it. These markets are also, very market makers of price determination. And as I submitted, they also help access to each person. Even the housewives today, they are great players in finance markets. Though it's common intelligence of millions of participants, it is sensitive to economic developments that can impact a security positively or adversely. Financial markets are easily accessible. They attract millions of investors who operate within this without leaving their desk. And the settlement processes are mostly straight-through processes with money flowing seamlessly across country in the least possible times. Because of the large number of people, playing in this market, the cost of transaction is virtually nil. Only, some carrying costs by mutual funds, or maybe, some processing fees by banks, are some of the charges, which are not very biting, are charged. As such, the cost of transaction in financial markets is reasonably low. And since large number of people, they will be taking investment decision in a particular issue of a bond or in a share. So you have the benefit, a free benefit of mass thinking about a particular product. You will read in newspapers and various magazines, various analysis of an issue, and for which you don't have to spend any money. So without doing your personal due diligence, you are fortunate that the risk sharing in a particular investment is shared by thousands of people around the world, and more the response, more the investment which flows into a particular thing, because people have understood that this product, this market offers you a lot of risk sharing benefits. The transactions in financial markets are truly risk sharing. The person who invests is different from the person who uses those funds. Now, this is also very important, because I may be a good investor, but I may not be a good industrialist. I may not be able to produce or manufacture things. Now, here the best thing is that risk from an investor who has surpluses passes on to the person who manufactures or who trades with that fund. So the risk is again divided this way also. So, and then as I submitted, a great amount of regulatory checking is done to use those funds. The funds cannot be simply siphoned off. A lot of controls and checks are there. I am a director in a public limited company which is traded. I know the number of returns every quarter we have to submit, every month we have to submit, and then we have to publish balance sheet every 3 months. And we have to have internal audit, external audit, and various other declarations. Then we have to have a register where stock holders can issue any complaint, with email being not costing anything. Hundreds of complaints flow in if the balance sheet is not received, if the performance is going down, if the order is not executed. So these are all regulated markets, so people should not worry in entering the financial market. Now, various types, financial markets are also very specialized. Like there is one flower market, a vegetable market, a cloth market. Similarly, the financial markets are also of various types. I rush through them. Stock market, which provides financing through issuance of shares. Bond market, which provides financing through issuance of bonds. Commodity market, that trades in the primary economic sector rather than manufactured products. Then money markets, as I submitted, bank is a part of a money market which provides short-term debt. Derivative markets, we'll speak about them a lot in today's deliberations. They provide instruments for the management of financial risk and, of course, for making fast money. Then there are future markets which provide standardized forward contracts for trading products at some future date. And of course, all of you know there is a massive worldwide foreign exchange market, the biggest market of financial markets, which facilitates the trading of foreign exchange. And of course, now a new market is coming up, which is called as cryptocurrency market, which is also raising its head. And you must be all proud that India has taken a lead, and Reserve Bank of India is going to issue India's own cryptocurrency, maybe by beginning of the next year. Now we come to money market. Money market facilitates short-term borrowing and instruments like commercial paper, certificate of deposit, and treasury bills. And it enables short-term lending like trade credit. If you discount a bill, what you do is a function of money market. If you open an LC, if that is also a part of money market business. Usually the assets are held for short terms and they do not exceed more than 1 year. The market enables banks to borrow for overnight cash flow mismatches also. Suppose for SLR or re-clearing, which you have received sometimes, thousands of crore of check has come and your funds position is not good. So what you enter is a money market and borrow for overnight or for a couple of days. Now we come to what exactly is the over-the-counter market. Over-the-counter market is only a flashy name. It is nothing. Over-the-counter market is doing business sitting across. If a customer comes, he stands at counter, he gives a check for FDR, and then he enters the banking hall, sits before you, where you sign the FDR. So he has worked at counter, he has now come to a table, and you hand him over and you see him off. So this business is called as over the counter business. So this is the bank is the over the counter market. OTC is dealing one to one by banks, institutions, corporates by trading through personal visit, telecall, or swift messages. Then business with funding needs of short-term financing interact here, and OTC provides liquidity in short term used as working capital. We can give a 12-month loan for working capital. That is also an OTC product. Now, the difference we will find when we enter further. Now, apart from the primary markets, we find that there is a market called as capital market. Capital market deals in stocks, bonds, and debentures. Now, these instruments are long term. They are more than 1 year, and some products of stocks can be perpetual, held over generations. You'll see that the State Bank of India's shares were held by your grandfather, then your father, then now you are having those shares. So some of the instruments, they long generations, they pass on. Some of the bonds, they will be 30 years, 15-year, 20-year bonds, which will pass on to generations. And capital markets, essentially, they provide long-term financing, and they feed for long-term capital requirements. And point is that market is volatile, reacting sharply to events in economy. Capital market, you will suddenly find the share value falling or going up because of some events. Even the president of United States, if he stumbles on the ladder to the aircraft and just falls down, then the stock market will collapse, because people will suddenly understand that the leader, the person who decides their shape of future, is not well. So these are very sentiment-driven markets, and they react to various events worldwide very, very sharply. Now, within the capital market, there are two types of markets. There is a primary market and there is a secondary market, and you will be understanding that these two markets are very, very user friendly. Now, major funding, like you see all the IPOs, initial public offers, which a lot of companies are coming for raising long-term capital, is coming out of the primary market. Then fresh issues of securities are offered to public in this market, where public buys directly from the company. Primary markets are very well organized, prices are fixed. Proceeds from sale of shares is income to the company. In primary market, the security can be sold only once, at the time of issuance. And most of the public issues are sold after protracted market making, and issuer in primary market has to undergo a lot of regulatory due diligence. What are the secondary market in the capital market? The secondary markets are, in this market, they trade securities between the investors and public. They can not buy directly from the company, but they can buy it from the owners of that security who have already bought from the company. The market is liquid and settlements are governed by timeline ethics. Proceeds of sale of share in income it goes to the investor. Unlike the primary market, where the proceed of sale of the issue goes to the company, here the sale of shares comes to the investor. Secondary market is more busier than primary market, as it continues to operate when there are no issues or IPOs in the primary market. We saw during Corona time there were no issues, but the secondary market was very active. Everybody residing at home from his computer was playing into what is called as secondary market, buying, selling security shares and all that. In secondary markets, securities can be sold many times, even during the day. Primary market does not have physical existence. Secondary market is set up as a stock exchange. We know, Mumbai Stock Exchange, the beautiful picture which comes every day. It is a secondary market. Of course, primary market issues can also come here, but then primary market need not have an edifice or a huge building. It's only the secondary market which should have. Secondary market does not warrant any legal or credibility due to due diligence by the buyer. It is your call. You want to invest in a share, you do it by your gut feeling or by whatever market buzz is. You need not go to a lawyer to understand that. So it's an easy to operate market. Now, briefly, we'll rush through what is the difference between money market and capital market. Short-term securities are traded in money market, whereas long-term securities are traded in capital market. Capital markets are well organized, whereas money markets are not that well organized. It's a comment on the service the banks give. Suppose you don't want to issue, mutual fund, then you will be closing one part of the market. Suppose your desk, in FDR is closed today because person on leave, so you are not having a short-term securities or a long-term securities market in the branch at that day. Liquidity is high in money market, whereas it is low in capital market. Capital market issues comes once in a while, but in money market, in bank, you can have money all the time. Due to high liquidity and low maturity in money market, instruments in money market are low risk. You can just go close your FDR or open for 15 days or say 1 year and then close it. So accessibility of funds in money market is very high. As such, it is low risk, and instruments in capital market are comparatively high risk. Everybody knows the bond value. Recently we saw gold bonds. Now they were purchased at say 4,800 rupees per gram. Today it is trading as 4,600. So investment in capital market instruments is high risk. Now, what are the major players? As I submitted, Reserve Bank of India is a major player in financial market, commercial banks, NBFCs, and then stock exchanges, again banks, and non-banking, again NBFCs, they also operate in capital markets. Money market players fulfill short-term working capital needs. Capital markets provide long-term financial and fixed capital to purchase land, property, building, machinery, and software, etc. Money markets provide liquidity in the economy. Capital market stabilizes the economy by mobilizing savings for long-term financing. Capital markets give high returns, whereas money markets give low returns because of the liquidity and short-term nature of the investment. We come to a different market now, friends. It's a very important market. Commodity market is a market that trades in the primary economic sector rather than manufactured goods. You can't go to financial market and buy your shirt. That will be a retail market. But here, if you deal into fabric, which makes the textile, which is the rather raw product rather than manufactured product, then it is called as a participant of commodity market. Soft commodities, there are two types of commodities. One is soft commodities, which are grown rather than mined, such as crops, corn, wheat, soybean, fruit and vegetables, livestock, cocoa, coffee and sugar. Hard commodities are commodities that are mined, such as gold, gemstones, metals, oil and gas. Now, the commodity market deals in both. The market includes physical trading and derivatives trading using spot prices, forwards, futures and options, for which we will learn more very shortly. Now, another market is the bond market. Now, bond market, again, banks are very important players. Most of your money towards SLR and CRR, etc. When you have to invest, the bank will invest in electricity board bonds or Government of India bonds. And a bond is an interest-bearing debt certificate. It is issued by large private organizations and government companies. Bond market is a market where bonds are issued to public for funds. Bonds help in raising funds for development by the government and expansion plans. So these are long-term instruments, and various type of bonds are there. You have corporate bonds, municipal bonds, government bonds, collateral debt, obligation bonds, and gold bonds. We enter into the next market, which is the world's biggest market. Doesn't sleep. It works 24/7. You catch a 2:30 flight in the night to New York. Enter an airport, you'll find a counter selling Forex. So it operates. You reach New Zealand by the afternoon. Again, you find a market there. You reach Australia in the evening. You find a person selling Forex. So it's a market which works 24/7, unlike the stock market, which works from say 10 o'clock to 9 o'clock to 3:30 in the afternoon. So foreign exchange market is a global decentralized over-the-counter market for trading currencies, and it's run by a global network of banks. Market determines foreign exchange rates for every currency. It includes buying, selling, and exchanging currencies at current or determined prices. It is a 24/7 market, and there are four major centers, which each one of you must know. These four centers, among themselves, do 75% of forex business in the world. These are Sydney, Tokyo, London, and New York. And why these centers? Because these are very important time zones. When now we are talking in the daytime, already it is evening in Sydney, and by that time, Sydney will sleep. Tokyo will open, and then by the time Tokyo becomes afternoon, it will be London which will be opening, and when London is afternoon, New York will rise. So these four markets, they catch up with each other. The rates in one market are carried over to the other market, and then they add premium or discounts and then quote forex rates. Forex market is very volatile with potential for high gains and high losses. In this market, if you are not a prudent player, you do not need to enter, because here the gains are huge and losses are equally huge. It's a very risky market. The five factors which influence forex markets are interest rates in a particular domain, economic stability of the country, the world events. If there is a fire in Aramco or in Saudi Arabia, then world over, the dollar and the oil prices will react. So the world events, they affect this forex market very much. And of course, if the government is highly indebted and the inflation in the country is very high, then the currency values, they go down drastically. We have seen in Zimbabwe, minimum currency note was 1 million Zimbabwean dollar. The value had totally evaporated because there was no productivity and inflation was more than 1,000%. Currency rates are in constant flux, regularly going up and down in value. Now, friends, derivative, I've been told by Professor Mahajan to explain it in very simple terms, because it's a very cosmetic term and everybody is scared what exactly is derivative. To the lady participants who are with us in this program, I will say, see, when you buy milk, and then you derive curd out of it, cheese out of it, butter out of it. These are very high value products. Milk is 40 rupees a liter, but cheese is 300 rupees kg, khoa, and many other products are much, much costlier. So derivatives are the byproducts. They simply speaking, they are nothing very great. These are the byproducts which come out of a main product. So derivative in terms of financial instruments is made very cosmetic, but today we'll discern that these are nothing, but also, something derived out of the financial products which we have been dealing in. A derivative is a financial instrument whose value is derived from a financial asset or commodity. Now, everybody uses petrol in his car or her car or diesel. What happens? The crude comes from, these Gulf countries. It is fed into fractionalization columns. Then, diesel comes out, which is used by, trucks. Then petrol comes out. Then premium petrol comes out. Aviation fuel comes out. Grease comes out. Various charcoal comes out. No, these are all derivatives, but they become so big that we, do not understand that these are only derivatives of crude oil. So the financial derivatives also come out of various financial products. Stock prices, share prices, bond prices, currency rates, interest rates, and dividends go up and down. They create a lot of risk. So derivatives are instruments who protect us from these financial risks. If you keep the milk for very long, it gets sour. But if you convert into cheese, it remains. It has some shelf life. So similarly, these things, these stock prices, they go up and down. If you take the support of derivatives here, buy some derivative to protect its value, then the value will sustain. So these derivatives help you sustain your risks. They manage your risks. Now they are being used as instruments of profit making also, which we learned. Price movements in the underlying security will necessarily affect the pricing of derivative based upon it. Now, if newspaper, it was costing say 200 rupees, then the kabadiwala will not buy raddi at 20 rupees a kg, because the underlying asset, the kabadi, is also a derivative of newspaper which you read every day. So the value of this thing is all related to the newspaper is so cheap now. So Kabadi Wala is also buying it low. So things are that when underlying security value is low, then derivative will also be lowly priced. If underlying value is high, then the derivative cost will also be very, very high. Derivative products are financial products that are used to control risk or paradoxically exploit risk. Derivative products or instruments help the issuer to gain an unusual profit also at times from issuing the instruments. I know a lot of people, they do forward covers in their foreign exchange exposures. So suppose now dollar, sometimes, has been stable for many months. So those who have been booking forward at higher price, they are making losses. Those who are not booking forward, they get a good return because by the time the bill is realized, the dollar has gone up by a rupee or 75 paisa. So their export proceeds uh, get them more than they were expecting. So these derivative products, they give you a lot of benefits. Sometimes, these foreign exchange contracts, if you cancel and the dollar rate has gone up, then also you make up what is called as markup and a profit. So people are misusing also these hedging facilities and forward covers for making profits. And derivatives can be both, they can be done across the counter or they can be exchange traded. Now, what are the over-the-counter derivatives? A person walks in, he says, "I'm, importing certain things, and it will cost me $1 lakh." He enters your branch. He says, "I want to buy a forward, so that at the time of retirement of bill, I pay 75 rupees per dollar." And you charge him some money, which is called as premium, and you issue a derivative, which is called as forward cover. And when the bill comes, he's already paid you premium. It may be less than the difference of the value of dollar has gone up. So he saves some money, and at that contracted rate, you retire the bill. So this is the over-the-counter thing. Over-the-counter markets do not need physical locations. In fact, trading is conducted electronically, while from his office itself, he can request you through email. You can book a forward, and he gets that counter derivative. In OTC market, dealers act as market makers by quoting prices at which they will buy and sell a security, currency, or other financial product. Sometimes you will be having, access to the treasury of some of the banks in Mumbai. Then you can talk to them. You can talk to Treasury of Canara Bank, simultaneously Treasury of SBI, and then take a better rate. So and book forward. So you have the option of contacting various OTC markets at the same time, and save your cost. Now, exchange trade derivatives are slightly different from over the counter. Here these trading exchange trade derivatives are options and futures traded on public exchanges. These are more transparent because this is not one to one. Like he does not go to various banks, and every bank puts his own or her own type of risk premium and profit booking. And in OTC you get so many rates, but in exchange trade derivatives, these are these derivatives are traded on exchanges, so these rates are accessible to anyone, and the market has priced them. So these exchange traded derivatives are more transparent. They are better than OTC derivatives, and then your competition will also get the same price. You will also get the same price, so they do not give an unnecessary edge to your competitor or to you while dealing in a particular foreign exchange or a commodity or any underlying security which you are intending to buy or sell. Now, exchange traded products are types of securities that track underlying securities. Obviously, ETP trades on exchanges similar to stocks, meaning the prices can fluctuate like stock prices. They can fluctuate, depending on demand and supply and about the sentiment of that particular industry or that particular product. They go on up and down, and the prices of ETPs are derived from the underlying investments. ETPs are usually low-cost alternatives to mutual funds and actively managed funds. We come to now various products which are part of our day-to-day life. Each one of you must have heard of the word of hedging. Hedging, is a boundary. You stay in a house, you create a boundary to, save you from animals or, unwanted people or a lot of, things which can disturb your harmony. So that boundary is called as hedging. Some people in computer technology call it firewalling. Now, hedging means preventing the financial and investment risk. In terms of financial market, it is a sort of a protection we buy or create around us or around our financial and investment instruments. It is exercised through financial instruments to offset the risk. Now, to create a fence, you use brick wall, iron, steel, and wood, and all that. But here, for financial instruments, what you use is now we'll be now deliberating deeply is called as derivative. Now, the instruments of hedging are forwards, futures, options, swaps, which are, as I submitted, are called as financial derivatives. Forwards is the most commonly used derivative. It's a forward contract, is a contract between two parties to buy or sell an asset at a specified future time at a price agreed on at the time of conclusion of contract. As I submitted, person walks in, he says, I have got a garment export bill of say $100,000. It will be realized in 90 days. You please send it. Please book a forward. I want to get at least $75 for 75 rupees for per dollar of export proceeds realized. Banker will do the due diligence. He says no 75. I'll give you 74.50. When the bill is realized, whether it is realized higher or low, the profit and losses will be mine. So these contracts, the forward contracts, they give you a sort of a emotional comfort that you are going to get at least this much once the bill is realized. These are bilateral contracts. These are settled at the end of agreement. Of course, when the event happens, when the export bill is realized, then only the forward will actually actualize. And it is traded over OTC as I submitted. And a forward contract can be used for hedging or speculation. I said there is a lot of speculation also going on. People take forward, cancel it when the rates move. By cancelling, they make a lot of good money. So, but it is a perfect, instrument for hedging the risks. Then, futures. Futures are mostly used in a stock market. These are contracts signed by two parties for trading a stock at a predetermined price. Like, forward, it is also a future where you agree, okay, yes, company ka share hai, this I will buy from you at this rate. Keeping the stop losses in mind, you work out a rate key and, the industry scenario, the demand for stock, the liquidity, the economic condition, the, corona condition, things like that. Then you put your stock on sale and then, enter into futures. Okay, on such and such date, I will sell it for this. And the future option asset has to be bought or sold. Then this is the difference. Here, this is a pakka agreement that you cannot go back tomorrow that no, I will not selling. This once you enter into a future contract, you'll have to do that. The prices move more, creating more liquidity. It is traded on exchanges and maintains. This is basically an exchange product, not OTC product, because it is a firm contract and it is visible to all, and it derives the price mechanism in the market. So it is traded on exchanges and maintains more value over time. Longer the futures, longer the gains. And then now the swap. Swap is a risk mitigating derivative. Again, it's a contract through which two parties exchange the cash flows or liabilities from two different financial instruments. Now, I have taken, say, housing loan from IndusInd Bank, and the interest rate was 8%. Now, I find that 8% is too high. Then I tell them, you just book, Indian rupee forward swap. You convert this 8% into a floating rate of interest. Now, having already done the contract at 8%, his asset and liability department has already, borrowed funds and then given you at 8%. Within that, they have tied up this liability. Now you want to change. So that contract of 8% will remain with them, and they will give you another contract. They'll make it floating. Now in floating, they will say, okay, MIBOR, like Mumbai inter offer rate, or any rate, any benchmark. They will say on that. They will say, okay, above this, say it is 5.5% MIBOR, and I'll add 2% to that. If MIBOR goes up or down, you are straight up. If it remains constant, you are saving 0.5% because you are paying me 8. Now you'll be paying 7.5. But if it goes up and down, then your cash flows, will be costlier. So that sort of arrangement where, two cash flows, they are exchanged for, again, containing the interest rate risk. These swaps, they protect you from interest rate risk basically. So such type of arrangements are called swaps. Swaps do not trade on exchanges and are OTC contracts. Again, these are all done mutually, sitting across the table. And the swaps are of various types like interest rate, currency, commodity, credit default swap. We'll deal with the CDS shortly. Interest rate swaps are mostly commonly. Out of these, most of the the interest rate swaps are the swaps which are very, very commonly used. And the swaps provide flexibility in designing and structuring contracts based on mutual agreement. Option is a contract that gives a right to buy or sell a specific security on a specific date at a specific price. As I submit that you are in two minds, whether you want to sell this security on a future date or not. So what you do is you enter into options. No, when you enter into options, then you say, I have option whether I will buy or sell. So naturally the cost will be high. A person who will be taking this risk by giving you this derivative, he is not sure whether he will get that security or not. So naturally, he will price the option at a particular premium, which will be slightly higher than the other type of derivatives. So option gives the buyer the right, but not the obligation to buy in future. You can buy, but you need not buy also. You cannot. You can opt to buy or sell as per your discretion. Prices under option contracts move less, creating less liquidity. Once the uncertainty is there, the product is not much sought after, so it moves less and it is less liquid. It is, of course, a risk mitigation and risk protection instrument that loses value quickly. If these options, they do not last long. Immediately on conclusion of the event, they are gone. And nobody buys them or keeps them, as investment. Credit default swaps, they are no more very, very popular because the banks have developed a huge expertise in credit appraisal. And then there are agencies, yesterday night we had a wonderful session created by Mr. Gulati from Dun & Bradstreet, who give you a total view of a corporate anywhere in the world, who also tell you how much exposure you can take. And then there are credit rating agencies who will give you credit. So credit default swaps, they have virtually evaporated, but then it is still an instrument. It's a financial contract that allows an investor to swap or offset the credit risk with that of another investor. Suppose you have given a loan to a firecracker manufacturing unit which only operates during Diwali, but he buys 2 crore, 3 crore worth of crackers, because for Diwali he has to hold. But he is heavily prone to, fire risk. So every time you give him drawings in his account, you're worried whether the industry itself will be consumed by fire before any pataka is sold. So here, you will go to another investor, tell him, sir, you take this risk, I'll pay you this premium, and if anything wrong happens, then whatever I'm going to gain, I'll share a part of it. So suppose you have exposed this particular asset at 8% interest, you will go and pay to the CDS seller say 0.5% or 1%, and your gain will go down. But then you are adequately risked, sort of protected from the risk, like an insurance company gives. The only thing is, it is not an insurance. Of course, you always take insurance on the assets of such risky or all the units which you finance. But here, this is a finance instrument where this risk is taken over by the other through, for protecting the default in the credit which you have extended. Collateralized debt obligations, these instruments were very, very, sort of blamed for the subprime crisis of 2008. And I was in Germany that time and was a witness to how this collateralized debt obligations, inundated and made Lehman Brothers vanish overnight, which was one of the largest investment bank in the world. What are these? These are also very funny products, like you give housing loan. Now, housing loan is a 15 to 30-year product, and every month you will get what is called as EMI. So what the intelligent market players in finance did was that they say, okay, this interest is assured, this installment is assured, you will get it. So they bundled, these cash flows of installment, or you can say EMI, and made out a product and said, okay, you are assured. This is a collateralized debt. Every collateral is there, land is there, house is there. Nobody will go. It's emotional security. It's a family security. So, on this security, these cash flows you buy and sell. They created this product. People started buying it, but then suddenly there was a glut in the housing market. There was, sort of recession. There was no money for paying the EMI. The ratings which these debts were given by AAA, because of 6 months long good track record of paying EMI. This is the best housing loan, and this is a group of best housing loan in this particular area in New York, because they always pay interest, EMI, everything in time. But suddenly when this glut started, the entire thing collapsed, and the entire market, people lost so much of money in this collateralized debt obligation. A CDO promises to pay investors in a prescribed sequence based on cash flow it collects from pools of bonds or assets it owns. CDO credit risk is assessed on probability of default derived from the ratings of the underlying asset as submitted. These are not very popular now. And what are intermediaries? As I had submitted, a financial intermediary is an entity that acts as the conduit between two parties in a financial transaction, such as a bank, investment bank, mutual fund, or pension. We are all intermediaries, and financial intermediaries offer, number of benefits to the average consumer. They provide you safety, guidance, liquidity, whatever you do in bank to the customer is what you provide as an intermediary to a customer. Although in certain cases, such as investing, advances in technology threaten to eliminate the financial intermediary, this intermediation is much less of a threat in other areas of finance, including banking and finance. Now you see, bill discounting people have come in the market, so your bank's bill discounting business is going away. You see now Paytm and things like that, payment banks have come. They've started paying EMIs of a housing loan also. So a lot of free float which you used to have in your savings account, current accounts, is now getting there. They are there when you pass through a signal or through a toll, you have to pay through that auto debit. Now that also is sort of a money spinner for these disintermediation sort of finance banks. You'll keep 1,000 rupees in that. That 1,000 would have been in your bank, but now it goes to them. They don't have any requirement of SLR or whatever, but they use that fund. So such challenges are coming to us. But then banks are and insurance companies, they have their own USPs, and they will survive. Now risk for as I have submitted intermediaries, there is a market risk, there is a liquidity risk, credit risk. All of us are, whatever we are facing in the bank while giving a loan is infested with risk, and all these risks are here. There is one which stands out is operational risk. Operational risk you cannot, estimate. In previous classes, you've heard Premlata ji telling that one whole bank, that bearing bank, was sold for $1. That is the operational risk damage which can come. Of course, the country risk, if there is no stability, then the asset you finance carries country risk. And we have seen the ILFS failure, bearing banks, Lehman Brothers, where these financial intermediation suffered heavily because of various risks, especially the operational risk. Now, how the derivatives are valued? Derivative valuations are based on rather two. I've mentioned here three, but I stipulated two components, that is future cash flows and present value of cash flow. If these are intact, cash flows are steady and they will come. They will actually actualize into some gain. Then naturally the value of derivative will be high. And valuation reflects the way entities think about risk. Derivatives are usually a combination of known cash flows and what is that to be determined. Because it's a problem of the unseen. It's all sort of guesswork, and the past record of the borrower, which derives the value of a derivative, and then market data, terms of contract, counterparty details, and legal agreements are ingredients of valuation. If you have a loose legal agreement, if you can't enforce a derivative, then what is the use of a derivative? So it should be supported with proper documentation, proper contract, proper understanding. Then only, you can have all these understandings will be based on a thorough study of market data, and which will create a good term of contract, so derivative will have higher value. Now, these are the exchanges. These are physical exchanges. All of you know BSE Mumbai does participation in equity derivatives, currency derivatives, interest rate derivatives, commodity derivatives, and debt. Similarly, India International Exchange GIFT City Gandhinagar is a new concept, but it is doing wonderfully well here. While sitting in India, you will be like operating like you are working in a foreign country. Then there is NSC, Indian Commodity Exchange Limited. There is Metropolitan Stock Exchange of India. Then this NCX, which is the most common commodity derivative exchange, and then there is National Commodity and Derivative Exchange based at Mumbai. And of course, all of us know there is IFSC Limited attached to NSE called NSE IFSC Limited, which is again in Ahmedabad, again dealing in derivatives in a large scale. There are a lot of disadvantages also. A company of say 200-300 crore worth is also nowadays struggling to enter financial markets to raise debt. There are too many formalities by regulatory bodies, and it takes a lot of time. It takes years. And then there are directives that last year balance sheet should have a specific level of net worth if you earn so many profits, if you want to really enter into this market. So you have to prepare much in advance to enter financial markets. Rules to enter the financial markets are stringent, requiring constant reporting, as I submitted in the opening, and monitoring requires huge assets, resources, manpower. Some of the markets like stock markets are addictive and time consuming. You see, most of the people you talk to today, they will be talking in terms of share kharida, becha. That sort of addictive thing has happened. People, get salary or borrow. I've seen a lot of, as a CVO, about 10% of the frauds happening in the bank by employees were, money taken from the customer's account and invested into stock market, and then earning there and paying back the customer or borrowing from customer. These are addictive things also. These one disadvantage is financial market has now thrown, and commodity markets are mostly speculative, and Forex markets are highly risky in the potential of high gains and high losses. Friends, you have listened very patiently. This is my last slide, and I would need only a couple of minutes to finish it off. What happened? There was a guy who was praying Lord very intently day in, day out. He used to worship in the morning, in the afternoon, in the evening, in the night. And one day God, appeared before him and asked him what he wants. He said he wants nothing. He just wants to pray and wants a life, where he should continue to pray. Then God said, having come here, I want to give you some gift. You asked for one. He said, I only want one prerogative. These we heard of derivatives. So this guy said, I want a prerogative. God said, what is that prerogative you want? He said, sir, when I die, I should have the option to select to go to either paradise or hell. God said, what is it? This is a very small request, but I give you this. Okay, when you die, it will be your choice whether you go to heaven or hell. So he said, I want, when his time came, then, Yamdut's people came and said, come, let's go. Then he asked, where do you want to take me? Then he said, we want to take you to hell because 99.99% people do all sorts of wrong things. And so they are destined to go to hell. But he immediately pulled out. He said, God has promised me that it will be my prerogative to decide where I go, whether to hell or heaven. He said, I want to select first. So he was shown hell first. The picture you are showing was more or less like this. There was a beautiful table laid with beautiful, cutlery, French windows, curtains, music, soft music, and beautiful food. He was surprised. He said, whether this is hell or heaven. They said it is hell. Then he said, show me the heaven. It must be better. Then they showed him heaven, and to his surprise, heaven was also similar, exactly similar, with similar rosewood table, rosewood chairs, and flowers and good food and everything there. He was confused. He said, what is the difference between heaven and hell? Then, he said, the ambassador of Yamdut said, you will see it yourself. Then after some time, these chairs were occupied in hell and in heaven by the people who were there. In heaven and hell, he saw a activity which made him open his eyes and understand what is the difference between heaven and hell. In hell, he saw people trying, when they had come there, their hands, they had become elongated. They could not bend these hands like this. So people were trying to still eat noodle. Nothing was going into the mouth. It was falling on the dining table, on their cloth. They were not able to eat properly, but they were feeling very weak, very hungry. But in heaven, he found people feeding each other because they could not bend hands, so they were feeding each other. Friends, the heaven and hell are here. If we cooperate, if we, help a customer when he lands up, and with so many Gandhijis on his, currency notes, we should immediately, think of Gandhi, who worked, selflessly for the entire nation, and is now a, chapter of inspiration for the world. We should help the customer. We should help him in, taking products of money market, of capital market. We should give him locker, create a relationship of bailee and bailer. We should try to sell him mutual fund, and thereby we'll be the most important creator of money market. I am thankful to each one of you having heard me. I will only close on these lines कि कौन है जिसमें कमी नहीं है, आसमां के पास भी तो जमी नहीं है. Derivatives are required to fence you from risk. Use them, but don't use them to destroy yourself. Thank you very much. Bye.
Thank you, sir. Thanks a lot. You have covered every product of financial market in such a nice manner, giving examples, giving analogies. Sir, covering such a huge subject within a period of 1 hour, really appreciable. So thank you, sir. You have made this subject highly interesting. Thanks, sir. Thanks a lot.
Sir, one clarification, sir.
Yeah.
Sir, whether there is forward transactions can be made without any underlying transactions. I mean to say any business transactions, things like that.
That's a very, very important question. RBI itself had permitted in good days that a part of the exporter's business forward cover can depend on speculation, and he can book forward without underlying. What was happening was, like, you have a contract with Colgate-Palmolive to supply ingredient worldwide on an ongoing basis. Year after year, our contracts are. So what you will do is, you will say, sir, I am into a regular export business. 85% of my products are going abroad. So I do not give you a contract. So RBI said 20% of your forwards can be done without giving a proper. But that was misused tremendously. And then the financial crisis came, and then now banks are not permitting it, even though RBI has not withdrawn the guideline. It is possible.
In future, it has to be, but in
big star trading houses, who are star exporting houses, they have permitted this luxury only to the extent of 20%. But banks are not doing it right now because of the misuse. Provision is there.
Thank you, sir. Sir, one more thing. If I say that credit default swaps we are not generally using, that is only because of minimum amount is very huge. That is why. Am I right on that? Otherwise,
yeah, size matters. You see, if you are into this market, you have to set up a shop. You have to create a lot of data. Whether this fellow will really default, whether this industry has a future, this product is accepted in the market, whether cash flows will really flow in. So you have to have a shop with so many experts. Now, to pay their salaries and their research expenses, you must have a minimum size, a critical mass of the product to sell. If there is a credit shop is done for 5 lakh housing loan, who will do it? Because he has to do study on that fellow's back checkup, his history, his salary, his contract of salary, whether his EMI will come. So a lot of research goes into this. As such, there is a critical mass required for CDS. That is why it is a not popular product.
yes, that I assume. Okay.
will request Mr. Hargovind Sachdev to kindly conclude his own sessions.
Sir, banker being the fulcrum of finance market, I dedicate these two lines to them. I say, खुद से जीतने की जिद है मुझे, खुद से जीतने की जिद है मुझे, मुझे खुद को ही जिताना है, मैं भीड़ नहीं हूँ दुनिया की, मेरे अंदर एक ज़माना है, और वो ज़माना है फाइनेंस वर्ल्ड. The more active player we are in this finance world, the more good will be the banking and more safe for our future. Thank you very much.
Thank you, all the participants. Thanks, all the dignitaries, and thanks, Mr. Hargovind Sachdev, for such a nice session. I'm closing this session.